All right, guys, warm welcome to another week ahead. This week's video will focus on the FOMC meeting as well as the Bank of England meeting. FOMC coming up Wednesday, Bank of England coming up Thursday, and where we do see the possibility of some mean reversion to the upside for pound dollar this week. Now, let's start with the dollar itself. The dollar has enjoyed a very, very strong, favorable run to the upside so far this year. From where we started the year to where we closed on Friday, we were up very close to 4%, very close to those prior cycle highs that we reached, of course, earlier in March. And the reasons for upside in the dollar has been plentiful, right? On the one hand, we've had safe haven inflows from the geopolitical stress. We also had a more hawkish than expected Fed from the start of the year. Markets expecting a more aggressive path for the Fed compared to most of the other peers right now, even the ones that has already started hiking. And there is, of course, the cyclical side where the dollar normally has that inverse correlation to the global economy. And that, of course, has been slowing and showing signs of more potential slowdown given the geopolitical stress right now. Now, the pound, on the other hand, hasn't been so lucky, right? We've seen a massive repricing to the downside in a very, very short space of time. The pound started the year as one of the outperformers, pushing to the upside both in January as well as February. And now in a very short space of time, we've just seen a massive amount of downside, partly driven by the BOE, which has turned more dovish in the language as of the recent Fed meeting, that hearing we had. We also, of course, have now rising inflation or stagflation risks in the mix, given the geopolitical situation. And then, of course, the proximity of war, but also the impact from sanctions has pressured the pound alongside the euro. Now, even though the Bank of England's February statement was hawkish because we had 4 out of 9 members voting for a 50 basis point hike and also raising their projections for inflation to above 7%, the bank definitely struck a more dovish tone, which was consistently followed through at the Treasury hearing meeting as well, or Treasury hearing as well. So alongside the geopolitical risks and, of course, sanction risks and growing stagflation risks, sterling gave up all of that prior gains we had and a little bit more, trading at levels last seen going back to February of last year. Now, let's take a look at what's priced in for these two central banks. Right now, on the dollar side, ster markets have once again shaken off those geopolitical jitters that we had, once again pricing in very close to 7 hikes for the Fed this year, currently sitting at 6.9 with an implied rate of 1.81%. On the Bank of England side, ster markets are pricing in something very similar. Markets again implying a cash rate close to 2% by the end of the year, which is just ridiculous right now to expect that the bank will reach that, getting close to 6, or just over 6 hikes priced for the markets. Now, with the implied rates for the Bank of England very close to that of the FOMC, why couldn't the pound muster more support? Well, firstly, again, markets believe that the Fed can deliver close to its implied path this year, whereas for the Bank of England, the markets don't expect the bank to be able to reach anywhere near what the markets have implied for the central bank, and that obviously created more downside drag for the currency. Now, even though a 25 basis point hike is basically 100% priced in for both of these, the pre-positioning for these two currencies are vastly different going into these meetings, right? That means that if we get a less hawkish than expected Fed, accompanied by a possible less dovish than expected Bank of England, that could see some decent short-term pound dollar upside, purely from a mean reversion point of view. There is also the question of history, whether history might repeat itself going into this FOMC hiking cycle. What do we mean by that? Well, we've seen some recent interesting research from JP Morgan that shows that out of the last 8 FOMC hiking cycles, the dollar appreciated quite substantially going into the first hike signaled by that vertical dashed line. And then we can see that we've seen very consistent downside or depreciation for the dollar the 6 months directly following the first hike. And that is regardless of how many hikes that took place after that first hike. Now, that is very, very interesting historical information. If we consider, what the markets firstly have already priced in for the Fed, which is close to 7 hikes. So we are arguably getting very close to a peak hawkishness scenario. If we consider that, and if we consider that net positioning is still very long the dollar. And if we consider just a massive amount of upside from a pre-positioning point of view and from a price action point of view, maybe history, has some potential to repeat itself here in the short term. And I want to stress though that I'm not looking for 6 months of downside for the dollar. The reason why I'm saying short term is there is that awkward thing called stagflation that is really a wild card for the dollar right now. um, Inflation, more accurately, stagflation, normally is normally seen as a positive environment for the US dollar. Remember, the dollar is normally inversely correlated to global growth. So when global growth is slowing, when you have more of a disinflationary environment, we have both growth and inflation slowing. That's normally good for the dollar. The other environment that's also good for the dollar is when you've got growth slowing but inflation staying high. Obviously, a stagflation environment. Now, it's important here, looking at this chart at the top left, it's important to understand that growth was already showing signs of decelerating going into the new year. That was even before we had the geopolitical situation that sent commodity prices surging, break-even inflation rate surging to the upside. Now, if you take a look at this growth rate, this is basically a growth tracker. It's a composite growth tracker using the NBER's preferred monthly measures of aggregate real economic activity. And that shows that very clear downward trend in growth. And that is now expected to be to accelerate to the downside, given the more recent risks we've seen from the geopolitical point of view. If we take a look at the chart on the bottom left, we can see this is looking at the composite ISM, basically manufacturing, including services. And we can see that on a 6-month smooth rate of change basis, that's seen a massive deceleration, obviously not pointing to great things for growth. Now, at the same time, looking at inflation, that is showing no signs of abating. And remember, this data doesn't include the recent jump we've seen in commodity prices across the board. It doesn't include the recent moves we've seen to the upside in inflation expectations. So, inflation staying high while growth is slowing and now potentially slowing faster. Classic stagflation or potential stagflation environment, which should be more positive for the dollar on balance. Now, taking a look at this chart below, I thought this was quite interesting. This is using CPI in blue and using the manufacturing ISM as a proxy here for overall economic activity. The reason why we didn't include services here is the data doesn't go far back enough to include some of these prior past inflation spikes that we've had. Now, I want to turn your attention to these times when we've had these big spikes to the upside in inflation. Big spike to the upside in inflation, followed by a big drag in economic activity. Big spike in inflation, big drag in economic activity. And that's played out over the past couple of decades. So every time that we've had these big inflation shocks, it has led to a slowdown in activity. Now, again, we're still going into an environment where commodity prices, the recent rise at least, still needs to be priced into it, inflation data. So we're still going to see even higher inflation, which means that as growth was expected to slow already, it's now expected to slow even faster, given the increase we've seen in inflation. So the reason why this is important to understand is that even if we do see a potential short-term mean reversion playing out based on this historical context, from this JP Morgan research, even if that does happen, and I do think there's a likelihood of that happening given where we've seen pre-positioning at, I do think it's going to be a short-term move, because as stagflation fears grow, as we start to see more and more slowdown in economic activity, that is expected to be positive inputs for the US dollar. Now, that is, of course, counterintuitive, because you could say that if the economy slows, then the Fed is going to slow their hiking. That should be negative for the dollar. And even though that is true, we need to understand that for the dollar, it's slightly different compared to other central banks, because the dollar is the reserve currency, which means that it's very closely related to global trade, to the global economy. When that slows, when global trade slows due to a slowdown, that normally increases the demand for the US dollar, despite what the Fed might be doing at that time. So that is an important consideration, or differentiation rather, to make between those two. So what are we saying then in a nutshell? Well, we're looking for some potential mean reversion in pound dollar this week. Given how close we arguably are to a peak hawkishness scenario for the Fed, close to 7 hikes that's priced in, and the big difference in the price action between what we've seen with the pound and what we've seen with the US dollar, we are looking for some short-term mean reversion in the event that the Fed's bar for being hawkish and the BOE's bar for being dovish might be a little bit too high for both of them, considering what's priced. Now, keep in mind, there is very little incentive for the Fed to suddenly turn dovish, right? Because Fed Chair Powell had made it very clear that the current transmission they're seeing in the markets from their forward guidance has already been correctly understood by the markets, and financial conditions have already started tightening in line with what they're expecting to do, and that is before they've even lifted a finger, right? So we're not calling for a dovish Fed. We are simply saying that the Fed will need to turn up much more hawkish, materially more hawkish than what's already priced in, to see a much bigger continuation in the upside for the dollar and in the upside for things like long end bond yields, in my opinion at least. So in other words, there is room for disappointment, not because of them not being hawkish. I think they're going to be hawkish, but potentially not being hawkish enough to see the markets pricing in even more than 7 hikes this year. Now, for sterling, with the recent consistent dovish remarks from the Bank of England, there is, of course, a risk that the geopolitical situation sees the bank turning up materially more dovish, with the amount of risk to stagflation. But if you consider what's already been priced out of sterling, the massive amount of downside that we've already seen, I think there's very little incentive for them to come out even more dovish right now. Firstly, because the labor market remains tight, right? We will get updated labor data coming out before the meeting. That will be important, not just on the labor front, but on the wage front. Remember, they are very focused right now on those second round effects. And we have seen that the bank's agents a report last week suggests that there are clear signs of significant wage increases this year. Now, that's going to place further pressure on them from the inflation front. And secondly, remember, apart from interest rate hikes, apart from quantitative tightening, one way that you can fight inflation is by having a stronger currency, right? So there's very little incentive for the Bank of England right now to jawbone the currency even more, which means that there might be more risks of upside compared to downside. Again, just purely based on what's already been priced out of sterling. Again, our call here is not that the Bank of England comes out super hawkish. It's not that the Fed comes in super dovish, but rather that the bar for continued downside in sterling and continued upside in the dollar looks fairly high from what's been priced in already, compared to what these central bank meetings might be able to deliver. So in terms of possible scenarios, then it's going to be fairly simple, guys. We're looking for a very high wage print from the jobs data. Remember, the employment side itself won't be important as the wage data. If that's a big beat, much higher than expected, that's going to increase the risks, or the fears at least, of second round effects. That should be positive for sterling. If that's a very low print, should be negative for sterling. If the Fed is not hawkish enough, or the Bank of England not quite dovish enough compared to what's priced in, expecting upside for pound dollar, the vice versa of that, a much more hawkish Fed or a much more dovish BOE expecting downside to play out. And then, of course, on the geopolitical front, because there's been so much stress, if you take a look at the options market, because there's been so much stress priced into sterling and the euro, from a proximity risk to the war, from a sanctions risk to the war, there is, of course, the risk, that if we do see a de-escalation, that we could see a very sharp reversal in some of these moves. Taking a look at implied volatility, we're right now back at 9.8%, quite a big jolt after that move lower last week. Risk reversals once again pushing back to the downside, meaning that markets are once again buying up a lot more puts versus calls, so buying up a lot of downside protection once again. Not a positive one for sterling, but again, if we see de-escalation, that could see a fairly sharp push back to the upside. And keep in mind, there has been a slightly more conciliatory tone coming out from both the Russians as well as the Ukrainians last week and over the weekend. So that is definitely a key upside risk factor that we need to watch for sterling in the week ahead as well. All right, guys, so with that said, I hope everybody will have a fantastic week ahead. As always, any questions, don't hesitate to let us know.